If you're curious about Forex trading and want to understand the basics, you're in the right place. The foreign exchange or Forex market is one of the largest and most liquid markets in the world, offering exciting opportunities, but also serious risks. Today, we'll cover 15 essential things every beginner should know before diving into Forex trading. Let's jump right in. This is Wealthvelocity. Here you create, protect, and grow your wealth fast. Forex trading, or foreign exchange trading, involves buying one currency and selling another. This exchange of currencies allows traders to speculate on whether one currency will rise or fall relative to another. Unlike stock markets, which close each day, the Forex market is open 24 hours a day, 5 days a week. Forex trading is unique because it's a global marketplace that operates round the clock. This means you can trade nearly any time, taking advantage of fluctuating prices driven by a variety of factors like economic indicators, interest rates, and geopolitical events. Understanding this global perspective is crucial, as Forex markets can be highly reactive and fast-paced. Currencies are traded in pairs, such as EUR-USD or GBP-JPY. The first currency in the pair is called the base currency, and the second is the quote currency. The price of the currency pair represents how much of the quote currency is needed to buy one unit of the base currency. Understanding currency pairs helps you realize that you're always buying one currency while selling another. Each pair has unique characteristics, and major pairs involving USD are often more stable and liquid, while exotic pairs can be more volatile and risky. Knowing which pairs suit your risk tolerance and trading style is essential for building a successful Forex strategy. Leverage allows Forex traders to control a large position with a relatively small initial investment, called margin. For instance, with 100-to-1 leverage, you could control a $10,000 position with just $100. However, leverage can be a double-edged sword. Leverage amplifies both gains and losses. While it allows you to maximize potential returns, a small adverse price movement could lead to significant losses, even exceeding your initial investment. For beginners, it's crucial to use leverage cautiously. Start with lower leverage ratios and avoid overextending your account. Pips and how they're calculated. A pip, or percentage in point, is the smallest unit of price movement in Forex, typically 0.0001 for most currency pairs. So, if EUR-USD moves from 1.1000 to 1.1010, it has increased by 10 pips. The value of a pip depends on the lot size you're trading. Pips are essential for measuring price movements and calculating profits or losses in Forex trading. Understanding pips helps you determine the potential impact of a trade, set stop loss and take profit levels, and manage risk. For example, in a standard lot, which is 100,000 units, each pip movement could mean a $10 gain or loss. The Forex market's operating hours. The Forex market operates 24 hours a day across major trading sessions: Asian, European, and North American. The overlap between the London and New York sessions usually brings the highest volume and volatility, which can lead to more trading opportunities. Knowing when the market is most active helps you plan trades according to your strategy. High liquidity during the London-New York overlap often results in tighter spreads, meaning lower costs for entering and exiting trades. Timing your trades to coincide with these peak periods can improve your chances of success. Going long versus going short. In Forex, you can go long, buy, if you believe the base currency will strengthen against the quote currency, or short, sell, if you think it will weaken. This flexibility allows traders to profit in both rising and falling markets, depending on the direction of the trade. Forex offers the freedom to go long or short without restrictions, unlike other markets where shorting can be limited. However, going short carries unique risks since prices can rise indefinitely, leading to potential unlimited losses. Understanding when to go long or short and having a risk management plan is essential. Types of Forex markets: spot, forward, and futures. Forex trading can happen in 3 main types of markets: the spot market, the forward market, and the futures market. The spot market involves the immediate exchange of currencies, which is the most common among retail traders. On the other hand, the forward market consists of custom contracts to buy or sell currencies at a future date with agreed terms. Lastly, The futures market features standardized contracts traded on exchanges with specific sizes and expiration dates. Retail traders typically operate in the spot market, where transactions are immediate. However, understanding the other markets provides insight into how large institutions and corporations use Forex to hedge against currency risk, adding stability to the global economy. Understanding the spread. The spread is the difference between the bid or sell and ask or buy price in a currency pair. Brokers make money through this spread, so the tighter the spread, the lower the cost to you. Generally, major pairs usually have tighter spreads, while exotic pairs have wider spreads. Spreads affect your trading cost, particularly in short-term trading. Wider spreads increase the cost of each trade, while tighter spreads reduce it. Choosing pairs with favorable spreads and trading during high liquidity sessions can help you manage costs more effectively. Fundamental analysis in Forex. Fundamental analysis involves studying economic indicators and news events to understand currency value changes. Key indicators include GDP growth, interest rates, inflation, and employment data. Central bank policies, like the Fed's interest rate decisions, also heavily impact currency movements. Fundamental analysis gives you insight into the economic health of a currency's country, which drives its long-term value. Staying informed on news and data releases helps you anticipate market reactions and take advantage of significant price movements driven by economic events. Technical analysis in Forex involves studying charts and using indicators like moving averages, RSI, and Fibonacci retracements to predict future price movements. Chart patterns, like support and resistance levels, help identify potential entry and exit points. Technical analysis is widely used in Forex for identifying trends and timing trades. Recognizing chart patterns and understanding how to use technical indicators can improve your decision-making, especially if you're focusing on short-term trades. Risk management in Forex includes setting stop-loss orders to limit potential losses using proper position sizing and setting a risk-to-reward ratio. A stop-loss order automatically closes a trade once it reaches a specific loss level, protecting your account from large drawdowns. Good risk management prevents your account from being wiped out by a single trade. Consistent position sizing and setting risk limits help you avoid emotional trading and focus on long-term profitability, which is especially important in a high-risk market like Forex. Choosing a reliable Forex broker is critical. Look for a broker with low spreads, clear fee structures, robust regulatory oversight, and a user-friendly trading platform. Consider additional features like educational resources and access to demo accounts. A reputable broker provides a secure trading environment, fair pricing, and reliable customer service. Regulatory oversight helps ensure that your funds are protected, while educational resources and demo accounts make it easier to learn and practice before trading with real money. Developing a trading strategy. A trading strategy is a structured plan that outlines your approach to the market, including entry and exit points, risk management, and your preferred timeframes. Popular strategies include day trading, swing trading, and long-term position trading. A strategy provides discipline and consistency, reducing impulsive decisions. By developing a clear trading plan based on thorough research and testing, you improve your chances of success and can avoid reacting emotionally to market fluctuations. The role of trading psychology. Trading psychology refers to managing your emotions, such as fear and greed, which can lead to impulsive decisions. For example, fear may cause you to close winning trades too early, while greed may lead to holding losing trades for too long. Your mindset is one of the biggest influences on your trading performance. Staying disciplined, following your strategy, and learning from mistakes helps you avoid common emotional traps that often lead to unnecessary losses. Practicing self-control is crucial for long-term success. Practicing with a demo account. Most brokers offer demo accounts where you can trade with virtual money. Demo accounts let you test strategies, explore the platform, and experience market dynamics without risking real money. A demo account allows beginners to learn without financial pressure, making it the perfect way to build confidence and refine strategies. Practicing on a demo account helps you develop a consistent approach, so when you're ready to go live, you'll have a solid foundation and clear goals. And that's it. 15 essential things every beginner needs to know about Forex trading. The Forex market offers exciting opportunities, but it also comes with unique risks. Make sure to understand these basics, practice with a demo account, and develop a solid trading strategy. If you found this video helpful, please like, subscribe, and share it with anyone interested in learning about Forex trading. Thanks for watching and happy trading.